Hey, what's going on everybody? Welcome back. It's Travis here with JT Wealth, and in today's video I'm going to go over the how and why to invest for beginners. So let's get into it. Alright everybody, like I said, welcome back. Thank you for being here. If you're new to the channel, we appreciate you checking us out. Hopefully you find something of value in today's video. If you do, don't forget, give us a big thumbs up and consider subscribing to the channel as well. Alright, so the reason I'm making this video today is because so much is happening and so much has changed with the investment world, right? There's so many new retail investors out there, and a lot of that probably has something to do with the Rona pandemic, which pushed a lot of people to start considering their financial situations. And then of course you had apps like Robinhood, M1 Finance, and Webull that opened up commission-free trading for the retail investor. So that really changed the investment world significantly. If you're considering opening a new account and would like to use one of those three, there's links in the description section down below that you can use that helps out the channel. So only if you're looking to do that, consider using the links down below. You might as well get some free stocks or a free $10 out of using my link compared to just starting on your own and getting nothing, right? But enough of that. They said that in the last 5 months, equity markets were flooded with more income, more money, than in the last 12 consecutive years combined. So that is a massive influx of new investors pooling their money into the markets. And of course, because stocks can only go up, right? What happened recently? In the last couple of months, that hasn't been the case. We've seen a lot of red days and we've seen a little bit of a correction. And what's happening right now is the retail investors, these new guys, they're getting scared. They're playing emotionally, they're withdrawing their money, and they're losing, guys. The only way the markets work is it's transferring of funds. Somebody has the money at all times, whether it's you or them, and them being the hedge funds and these big investors, or just anybody who's more patient than you. If you are selling out because the market is down, you are in effect losing money you don't have to lose. But we're going to get into that later. So in this video, I tried to consolidate a lot of the good information I was able to find on the internet or just information I'm familiar with already and kind of pool it together to make a fairly concise, basic level investment video, hopefully to help a new investor who's considering getting into the market, or perhaps somebody who's joined the market in the last year who didn't otherwise know this information, and it might be able to make them a little bit smarter, a little bit capable of making better decisions in the future. If you're down right now and don't understand why, or if you're looking to make your next move but don't want to make the same mistakes you've made in the past, hopefully this will help. Okay, and lastly, before we get into the slides and we go over the topics of the video, I just want to remind you guys that if you are here to see Julie, she can be found on the TipRanks YouTube channel Monday through Friday, where she does the pre-market morning update videos, as well as some other videos throughout the day and how-tos on how to use TipRanks platform. So fantastic videos, and make sure you go check her out over on the TipRanks YouTube channel. So now let's dive right into the main points of today's video. Alright, there it is. Like I said, this is basically investing for beginners. But I want to caveat that with, this is just investing explained for beginners. You can utilize this information whether you've been investing for 6 months, 6 years, or 40 years. It really doesn't matter. The information that I'm going to present to you today will remain the same. Of course, there would be separate tax implications, etc., as you progress through your investing career, but the basic information that we're presenting can be utilized no matter where you are in your investment career. So first and foremost, let's look at some basic rules for investing. Alright, so here I labeled out 7 rules of investing, and they're fairly simple, straightforward, understandable rules, but we're going to break them down a little bit. So the first is just invest in yourself first, and this can be taken a lot of different ways. Some people would say invest in yourself in terms of education or making sure that you learn a monetizable skill, or others would just say that make sure that your investments for yourself come first, meaning that you take that investment and put it into your index fund or your 401k, whatever the case is, even before you start paying your bills. Okay, so that's the first one. Then invest for the long haul, buy and hold. This is one of the things that I think has beaten a lot of new retail investors. You're looking to beat the market. Don't try to do that. Find long-term blue chip stocks or index funds, mutual funds, whatever the case may be. Buy them and hold on to them for the long term, okay? This is the most simplistic way to approach investing. Is it always going to be the most effective? No, there's going to be people out there who are going to buy the next GameStonk or whatever, and they're going to make a crazy amount of money overnight. But that's not sustainable. You want to approach this from a long-term perspective. Okay, next, invest in areas you understand. Basically, if you can't explain to your kid why you're investing in a company, you probably shouldn't be invested in them. You want to make sure you understand the company, what they're providing to the consumer, what value do they give to the world. Because if they have a massive opportunity there, then you know that that's a company that's going to be around for the long term. Only invest money you don't need. Now, this is one of those things that sounds very simple, but sometimes you consider, hey, I don't know, maybe I might need that money in 60 days or in 6 months. And if that's the case, that should be in your emergency fund, not your investment money. So make sure that the money you're investing is money that you've already accounted for and decided this is going to be placed in an account only for investment purposes, and you've got that emergency fund already set up. Okay, that's more along the lines of budgeting and something you would want to consider even before deciding that you're going to jump into investments. Okay, next, do not try to time the market. I want to say that again. Do not try to time the market. Buying on a dip in bear markets, that's not the same. That's not what we're saying here. What we're saying is you're not going to win. Okay? Historically, you cannot beat the market, okay? Just don't try. Just accept that and move on, okay? Now, when I put on there dip buying, bear market purchases, etc., that's not timing the market. That's understanding cyclical situations and being greedy when others are fearful, right? That great Warren Buffett quote. So that's a little bit separate of an issue. Okay, invest early and often. This comes in line with the investing for the long haul, right? The buy and hold strategy. Except here, you're going to start now. You're going to start today. All right, make the decision to start investing today. And then do it often, meaning every time you get paid, you're going to start putting aside a certain amount of money. And that's going to build, and you're going to see the value of compounding interest. And we're going to get into that a little bit more later on in today's video. Lastly, your emotions are not real. They have no place in your investment strategy. I think that last one is what's causing a lot of retail investors to jump ship recently, okay? You're getting beat. You're being beat because the market's down and the long-term investors, the hedge funds, the big guys that have been doing this for years, they're not smarter than you. They're just not playing with their emotions. Okay, they understand that the market is cyclical. There's going to be the ups and downs, and stonks do not just go up, okay? So emotions are the thing that will get you beat the fastest in this world, okay? And there's a saying that says something to the effect of, you gotta pay your market tuition, right? And it's just like if you were going to school. If you want to learn a new skill, and trading is one heck of a difficult skill, you're gonna pay that market tuition. You are gonna lose a lot of money learning how to play in this market. So the best way to not lose that money, don't play the market. Don't try to beat it, okay? Leave your emotions at home. Invest early and often and hold. Okay, so that all being said, some basic rules covered. Let's look now to investment mistakes. All right, and it starts right off with trying to time the market, right? If that was one of the rules, that's obviously going to be one of the mistakes. Do not try to time the market. Not investing early and often. Big investing mistake. You're going to lose out on so much compounding interest. Only investing for the short term. This is one of those issues that's going to get you caught up in emotions. Okay, you're going to find yourself in a situation where you thought something was going to go up, all of a sudden it's down, and you want to get out before you lose any more money. That's not a good way to approach this. Chasing hype stonks. Okay, this was a prime example with GameStop, guys. This got so blown out of proportion with social media, and did a lot of people make money? Of course. Are a lot of people making money right now off Dogecoin? Yes. Would I recommend you buying either of those stocks? No, I can't justify it. Chasing past performance. And this is one of those things where you have to recognize that past performance does not tell you whether or not the new year is going to do well or if it's going to do poorly. You can't anticipate future performance based on past performance. I think that's an easier way to explain that. But just understand that just because last year an index fund did 7 to 8% doesn't mean that they're going to do it this year. You can just anticipate a long time frame, right? Okay, only investing in individual stocks. Here's something that I feel like it could go either way, right? If you're investing in individual stocks, I think what they're saying is don't just buy one, okay? Obviously you understand the index funds, etc. They are a grouping of individual stocks. So they're not saying individual stocks are bad. They're saying just make sure you have a kind of diverse portfolio of stocks and that you're not just 100% in on one stock. Okay, being impatient. We all understand that this game is to set yourself up for financial freedom, right? You build with financial literacy and you set yourself and your family up for financial freedom. And that doesn't come quickly. This isn't a speed race here. It's not a sprint. This is definitely a tortoise versus the hare situation. Being impatient will lose you money. And I think that's the easiest way to look at this, is anything that is going to lose you money, you want to avoid. And of course, lastly, emotions. I think we covered emotions enough when we went through the rules, so we're not going to rehash that. But suffice it to say, if you do get involved in emotions, a lot of those other mistakes are going to follow, because you're going to make those same mistakes as a result of being scared, right? So you need to stay long-term, not short-term, be diverse, and just cover down on those very simple bases so that you don't get caught up in being scared, trying to time the market, following social media hype, making decisions based on somebody else's opinion instead of your own. I also forgot to mention, I apologize for the backdrop kind of being bland and boring today. We're in the middle of a move, so a lot of our stuff is in transit, and hopefully we'll have the new studio set up for you guys shortly, maybe by the end of next week. But yeah, if you notice things are a little bit in disarray, we apologize for that. All right, next I want to go into something that I deal with almost on a daily basis, and I deal with it with the people I work with the people I see out in town, anybody I meet or hang out with and talk to. I tend to just talk finance, right? It's my passion. It's something that I'm intrigued with, and I like to see what other people's opinions and thoughts on it are. So here is something that I deal with frequently, and if you find yourself in this situation as well, yeah, here we go. All right, the biggest lies you can tell yourself. Guys, when somebody says, are you investing? Are you putting money in your 401k? Are you saving for your future? I hear these excuses so many times. I can't afford it. I have too many bills. I need the money. This is unfortunately a very real situation for a lot of people, right? You find yourself in that paycheck to paycheck cycle where you just don't know where your money's going. You don't have a budget. You haven't sat down and figured out where you're spending your money, or you just don't make enough money, which is of course the issue for a lot of people, right? I'm not saying there's not individuals out there who have an awful situation and aren't making enough money to make ends meet. In that situation, you guys just have to keep pushing, man. You got to find a way to increase your skill set so you can monetize yourself a little bit better, get a better career that's going to pay a little bit more money, but don't give up. That is the next goal. Set yourself up for success so that you can invest once your budget is in a strong position. But for most of the people I see on a daily basis or deal with recently, that's not the situation. These are just individuals who have poor budgeting skills, poor money management, poor time management in some of the instances, but I can't afford it. Whatever the case may be, right? Whatever the storyline is, it's a lie. You're lying to yourself because you can't afford not to. And I mean that. You literally are setting up your future self for failure by not acting today, right? You're being greedy today by wanting to spend every last dime you have, and you're gonna set yourself and your future up for failure because you're just too greedy right now, right? You want that immediate gratification, and that's just not a way to be successful in this game. Unfortunately, finance is a lot like fitness, and it's not like there's a pill to solve your problems, right? You're gonna ask anybody out there who's a premier level athlete how'd they get there, and it's gonna be diet and working out, right? And diet is difficult, it's time consuming, it's not immediate, it's delayed gratification, it's chicken and rice and not eating ice cream or not drinking beer all the time. It's just the slow and steady progress, right? And that's the same way with your finances. But even the smallest amount, guys, and I mean this, the smallest amount of money can make a huge difference in your financial future. Let's take a look at the next graph where we talk about even if you just invested $25 a week, how much you would end up with in the long term. So why even the smallest investment matters? Look at these numbers, guys. If you're just investing $25 a week into a low-cost index fund with a 10% ROR, rate of return, you're going to have a 30-year investment of $224,159. That's a lot of money to have for just saying you're putting away only $25 a week. Guys, literally that's $100 a month. Okay, that's negligible. That should be easy for most of you. If you're investing $75 a week, look at that 30-year price target, $672, $477. Let's skip all the way down. If you're doing $125 a week, that's over $1 million in 30 years, guys. That should be the goal right there. You should know how much you need to be investing every week, every month to reach that $1 million goal. Now, $1 million is a lot of money, right? That's an immense amount of money. That's actual wealth, right? But I think it's exceedingly attainable, and you can definitely set yourself up to be a millionaire. Now, I want to showcase another person that I found on Instagram, and I've talked about her in the past, but she put out this fantastic image that kind of shows if you're X age, how much you need to be investing to reach that $1 million milestone. So let's take a look at that. All right, and that is Leandra over at Female in Finance on Instagram, so make sure you check her out. But this is a fantastic image, weekly investment to become a millionaire. So she showcases starting at age 20 and going all the way down to age 50, how much money you would have to be putting in every single week to reach $1 million milestone by age 65, okay? So I'm assuming here there's maybe a similar 10% ROR, maybe it's an 8% ROR. I'm not 100% sure what, range she used there. But look, $26 a week, guys. So if you're 20 years old right now and you're watching this video, please, please, please start doing this. $26 a week minimum. You can definitely increase this as you go on. If you're 25 already, look how much that's jumped up, almost twice as much, $45 a week. If you're 30, $70 a week. If you're 35, look at the difference between 20 and 35. Now it's $115 a week to reach that same goal. That's only 30 years later for them. If you're 40 years old, $190 a week, 45, $325 a week, and 50, $580 a week to reach $1 million 15 years later when you hit 65. All right, so that graph is a perfect representation of why you need to start investing early and often. There was a $164 difference between the person who's 40 and the person who's 20. $164 a week difference. So if you started early, you're going to be able to set yourself up for success much better than somebody who started later on in life. All right, the next image I have for you guys came from another financial Instagrammer, and it's basically showing why you shouldn't try to time the market. So let's check it out. All right, so I love this image, and this came from the financial motto, and it's why you shouldn't try to time the market. It looks at a growth of a $10,000 investment made in 1980 in the S&P 500, so basically an index fund. So if that $10,000 stayed invested from 1980 to 2018, all of the days, it would have been a $708,143 investment by 2018. Now that's fantastic, right? That's the goal. If you missed just the best 5 days in that time frame, you've already lost and you're down to $458,476. Okay, what if you missed the 10 best days? Now you have cut your investment in half by only missing 10 of the best days in what, a 38-year period? So 10 days in 38 years and you've cut your investment in half and now only have $341,484. If you missed 30 days in that time frame, 1 month out of 38 years, you would only have $135,226. Now look at that last one. If you missed less than 2 months of the best days in the S&P 500 market, your $10,000 investment would have gone from $708,143 all the way down to $62,000. I think that is an extremely profound image and definitely gives you the concepts that I'm putting out here. You definitely want to be invested early and often and just leave it alone. Okay, forget it's there. Keep putting money into it and occasionally check up on it, make sure it's set up accordingly. If you're doing a time-based ETF or index fund, you want to set that up accordingly and manipulate it as you need to. But that's a little bit more advanced stuff. That's not for today's video. Okay, so next, there's a really cool image that talks about the best and worst months for the market and showcases when those are. And this is by the same Instagrammer, so let's look at that. Okay, so this is just average market returns by month, and it shows the S&P 500's monthly performance from 1971 all the way to 2020. So for the last 50 years. So this will give you a really good idea of what you can expect. It's not always going to be that way, but what you can expect in the S&P 500 month by month. So you can see April has a fantastic history, right? 1.71%. That's on average, guys. Of course, there's going to be better months, there's going to be worse months, but that's the average for April. Whereas September has almost a 1% negative rate, right? So this is just a way for you to kind of go back and look at 50 years worth of performance and say, okay, so if I'm up more than 1.71% in April, I'm doing better than the S&P 500's 50-year historical average. Just another kind of cool imagery that I thought I would share with you guys. Make sure you check out both of those Instagrammers, as they have material that they're putting out almost daily, if not daily, that can really help motivate and educate you on your path to financial freedom. Okay, but now let's take a look at some of the best ways that you can start your investment journey now that you have an understanding of how to go about doing that. So here I just listed out 3 investment types to consider as a beginner. And of course this works for anybody, but it's just kind of intro level investing advice, or information as it were, because I'm not giving you advice. But index funds, right? ETFs. So you can invest in the tickers VTI, VOO, which are S&P tracked index funds. If that's not your thing, if you're maybe a dividend stock investor and you want to really reap the benefits of those dividend stocks, which I love, you can look at J&J, MO, KO, Triple M. These are all really great dividend king stocks, which means that they have over 50 years of consecutive dividend raises and paying out to their stockholders. Okay, so, or you can look at growth stocks, and this is something that has been doing exceedingly well recently, and in some cases over the long term, but looking at Apple, Tesla, Disney, Google, Amazon, Microsoft, CRM, these are all growth stock companies that you could consider investing in for the long haul as well. These I would just check in on a little bit more, but for example, I own Apple, I own Tesla, I own CRM and Microsoft, and these are things I have no intention of selling anytime soon. I'm going to hold them for the long haul. So just considerations, right? Index funds are fantastic to set yourself up for the long haul. There's a small fee associated with them, but they, especially VTI does absolutely amazing over the long term. You're going to have a hard time finding any fund that is going to beat that. And again, like I said, dividends are they're fantastic. I love dividend stocks. So consider these 3 options when making your first or next investment portfolio. All right, and lastly, I just kind of want to go over where you can hold these funds. As you start considering your investments, there's multiple applications for how you can invest your money. It doesn't just have to be in a stock portfolio. It doesn't just have to be on Robinhood. There's a multitude of different ways. So let's take a look at a few of them. All right, so where to hold your investments? I basically just listed some of the most common. You've got your Roth IRAs, okay, which grow tax-free, but they have a $6,000 limit per year. Okay, they are also post-tax. You've got your 401ks, which are pre-tax. They are tax-deferred. They have a $19,500 per year limit. And your choices of investments are limited. However, you more often than not have an employer match. So if you have the opportunity to be invested in a 401k, you definitely want to invest in it at least up to your employer match, right? At that point, you may want to consider moving whatever remaining funds you want to invest over to that Roth IRA and attempt to reach that $6,000 limit. Okay. Now, reverting back to that and why you would want to do that, your 401k is going to be put into the account before it's taxed, and then it will be tax deferred. However, when you retire, you will be taxed on your 401k withdrawals. Whereas the money you put into a Roth IRA, it says right there, you're putting it in post-tax, which means you've already paid the tax on that. It then sits and grows in that Roth IRA tax-free. And when you take out your Roth IRA upon retirement, that money is not taxed, okay? So that's the benefit of kind of utilizing both the 401k and the Roth IRA. Okay, but moving on, you've got your traditional IRAs, which are also pre-tax, and they can reduce your taxable income. They also have a $6,000 a year maximum limit. Lastly, of course, are the brokerage accounts, right? The Robinhood, Webull, you can use TD Ameritrade, M1 Finance. If you're a crypto investor, you can use all sorts of different crypto options, like Coinbase just had their new IPO. BlockFi is a great one that you can utilize because they give really, really good percentages on the crypto that you're storing with them, as well as the US dollar coin, the GUSD, the Gemini US dollar coin that they have. I think it's something like 8.6%, guys. You're not gonna beat that. So all of these are fantastic options for where to hold your investments. Regardless of which choice you take, just choose one or two of them and start this journey. All right, I know it was a lot of information, and a lot of it I tried to keep at the most basic of levels, so you may have a lot of questions. If you do, please leave me a comment in the comment section down below. Let me know what your questions are, things that you want me to address. I can do a follow-up video on any of the topics that we've covered today if that's something that you really would like to hear. Also, if you have more questions on investing or want a little bit more one-on-one or more isolated help, you can consider joining the Discord, which has a link in the description section down below, where you'll be able to reach myself or Julie and a lot of our other people in that group who are fantastic financial minds and really do have a passion for finance, for financial freedom, for the FIRE community. So this is a great way for us all to get together and answer questions with like-minded people and just share the journey that we're on. So consider doing that if you really have some questions. Okay, hopefully you enjoyed today's video and found something of value in it. If you're a new investor, please consider starting your journey today, all right? Today is the best day to do it. Yesterday is the best day, but today's the second best day, right? But early and often, start right away, guys. That's the best way to set yourself up for financial freedom. Again, I am not a financial advisor. I'm not your financial advisor. So all of this is just for information and entertainment purposes only. Please be smart. Utilize your hard-earned money the best way you see fit. Do your own research and due diligence before investing in anything. And for those of you who noticed I didn't have a Bud Light today, I switched it up. I've got the Jameson Cold Brew. It's delicious. Consider giving that a shot as well. They don't pay me anything, so just enjoy that. Thank you so much for joining us today, guys. I hope you have a fantastic Monday, and bottoms up.